Peter, good to see you. Welcome back, everyone. I'm really excited about today's topic because I feel like we're getting back to basics, defining your risk tolerance and expectations for returns. The relationship between risk and return is fundamental when it comes to investing. Generally, higher returns come with higher risk, and lower risk typically means lower potential returns. So to start, can you explain what risk tolerance is and why it's important for investors?
Risk tolerance is essentially your willingness and capability of seeing losses in your account before you get too nervous to stomach them.
Yeah.
Ultimately, it is how much are you willing to or can you afford to lose? It is always the litmus test is on the downside. And so, one aspect of risk tolerance that I sometimes take issue with is how it's presented as taking more risk necessarily correlates with more growth. It's growth potential, right? And it's the downside. It is the risk of loss that is the true litmus test for somebody's risk tolerance. And we really need to focus on that downside in order to begin to assess, evaluate, and define someone's risk tolerance.
Mhm. So, how do we go about then really figuring out what our risk tolerance is? I feel like I've taken some questionnaire when I do my target date fund with my 401k or something, right?
Yeah. Well, I mean, the true test is going to be when the market has a downturn, how nervous, how panicked, how sick to your stomach do you feel? But we need to try to define that ahead of time. So that is part and parcel of setting up an account and allocating and investing in an account and working with an advisor certainly should help you ahead of time to try to define this. And generally, it is through a risk tolerance questionnaire. And the first question, and one that's most important, is how do you define your own risk tolerance? Are you conservative, moderate, aggressive, somewhere in between there? And then there are a myriad of other questions that will follow that up and really try to define what your risk tolerance is. My first question that I always refer to in that, and really at the end, the result that I compare to is how did this kind of arbitrary point system score on the risk profile questionnaire correlate with your personal answer to this question? And if they match, fantastic. We're probably on target. But if one of them was that I am moderately aggressive and the other one tested out that I am conservative or vice versa, if they are not correlating or closely matching, then we really need to define why that is. And a lot of times that comes down to your comfort level with risk, your
Mhm.
time horizon that you plan to continue to be invested before needing to withdraw the money, or the reliance on income from that account at current. How long you plan on leaving it invested plays a large role into that the answer in the scoring system.
Right.
If it's slightly off, it may not be the biggest of deals, but you sort of want to try to hone in on why there's any disparity between your answer and a score that would have been generated from a comprehensive risk tolerance questionnaire before getting invested.
Right. So, and we are taking a look at the results here of a questionnaire. It's RPQ score, right, Peter? But
Yep.
how accurate is this number or representation then?
Well, I mean, again, it gets tested when the market goes down, but it generally is fairly reliable and should begin to give you guidelines, right? Is that these are the guardrails that keep you on track and will try to begin to set expectations for what your results will be based on what the market does. And it's not going to be exact and specific of you are going to get this exact return, but it gives kind of a range that you could begin to base expectations off of.
hmm So, can an investor's risk tolerance change over time? And should changes in the market affect our risk tolerance?
Yes and no. Certainly an investor's risk tolerance can and should change over time. So there's this old rule of thumb called the rule of 100, which
Hmm.
it begins to give us some additional guidelines for how much of our investment capital should be at risk. And it says your age with a percentage after it likely shouldn't have a whole lot of risk, and 100 minus your age with a percentage after it should be exposed to risk. So, in other words, a 25-year-old can probably afford to take significantly more risk than a 65-year-old because they've got plenty of time on their side to continue investing, whereas a 65-year-old may be in close range to needing to rely on their investment capital to withdraw and produce an income. Um, does it change with downturns in the market, specifically downturns usually, because everybody's willing to take all the risk in the world when the market's going up? But should market conditions dictate it? It really shouldn't, but it does, because this is when people really have that gut check of, okay, are the answers that I answered correct and accurate for how much risk I am willing to take? If I made an investment of X amount of dollars and the market goes down and I see it fall to Y, well, am I comfortable with that? And why or why not am I? Do I need to sort of reassess my risk exposure and therefore my risk
Hmm.
tolerance comfort level?
Hmm. So, what is the role of working with an advisor, and how does an accurate risk tolerance define both an investor and advisor's expectations?
Well, if we bring that chart back up of the risk tolerance questionnaire results, is that we see that there are different grades on the spectrum, all the way from conservative to moderately conservative, moderate, all the way to aggressive. And then there are some general guidelines for how much you should have exposed to equities versus how much you should have exposed to fixed income. So if we just look at the moderate column, right, the equity exposure should be between 30 to 60%, and the fixed income exposure should be the balance, so between 40 to 70%. And so this sort of gives us an additional guideline for the expectations for returns, is that a moderate investor should not have all of their capital exposed to the market and therefore should not expect the full return of the market. Let's sort of split this down the middle and say it's a 50-50 mix, right? That therefore 50% of your money is sort of earning prevailing interest rates. It's exposed to fixed income. So let's say that bonds and bond funds are yielding 4%. You've got half of your money exposed to that. So half of your portfolio would have gained about 2%, whereas the other half, 50% of your portfolio, is exposed to equities. And let's just say that the market went up 10% in a year. Well, that half of your money therefore generated you a 5% return on the total portfolio. So now we take the gains from the fixed income and the gains from the equity, 2 plus 5, you got about a 7% rate of return. But in theory, the fixed income portion would hopefully not have as much market fluctuation. And
Hmm.
so in opposition to that last kind of counter to that last example, if the market is down 20% in a year, only half of your money is exposed to that. So you did not lose nearly as much as the market either. And you see the range on that chart is kind of given a different spectrum, 30 to 60% exposed to the market. Well, in rising markets, hopefully working with an advisor, you are pretty well honed in on where you should be within this chart. But hopefully the advisor being proactive is looking to help you capture closer to 60% of the market movement on the way up, and is closer to the 30% of the market movement if the market is falling.
Hmm.
And so that is really the benefit of working with a proactive advisor who is trying to not only define your risk tolerance, find where you lie in that chart, but within your risk tolerance, capture the movement of the market appropriately.
Right. Because if you don't feel comfortable, then you don't stick to your plan.
Yeah, and we've seen knee-jerk reactions ruin well intended investments time and time again, because people generally, if they don't have the plan, they react to
Yeah.
movements in the market,
Yeah.
and get emotional, and
Yeah.
then unfortunately that leads more often than not to mistakes rather than success with
Right.
investing.
Right. Well, Peter, if somebody would like to have this conversation with you, take that questionnaire, find their own unique risk tolerance, how can they reach you?
Yeah, and it is important. So give me a call if you'd like to review and evaluate your current portfolio, understand the risks that you're taking, what you own in your portfolio, how much risk you're actually exposed to. And risk tolerance versus risk exposure is a place where I tend to find a whole lot of disparity, meaning that a lot of people are taking more risks than they are truly comfortable with once we really try to evaluate what it is that they own. And a lot of times that's something that once somebody sees it, they do want to take some proactive steps to try to correct that. And by the way, the appreciation of the market has actually led to people taking more risks than maybe they were taking 3, 5, 10 years ago
Right.
over a course of time when they should be taking less risk. So it's important to review this periodically, period. But if you would like to do so proactively and have a chat and really understand your risk tolerance and your risk exposure, and are they matched, give me a call, 919-300-5886, 919-300-5886, or you can go online. It looks like richonplanning.com. It is richonplanning.com, or you can email me, peter@richonplanning.com.
Great. Peter, thank you.
Always a pleasure, Erin. Thank you. Hey folks, Peter Richon here with Richon Planning. So glad that you are enjoying the podcast, Planning Matters Radio. You know, one of the tools that we've put out there that people really seem to appreciate and really are finding of value is at 919retired.com. It is your retirement tax bill calculator. If you've got any kind of retirement account, your tax deferred, 401k, or IRA, this is the website, this is the resource where you can go, you can plug in your own numbers, your information, you can slide the tool calculator up and down for your tax rate or your amount of savings and see what your tax bill is likely to be if you default and defer to the IRS's plan versus what you could potentially bring that tax bill down to. A lot of times it is a very significant savings. So if you have not yet, go to the website 919retired.com, run your numbers on the retirement tax bill calculator.
This has been Planning Matters Radio.
The content of this radio show is provided for informational purposes only and is not a solicitation or recommendation of any investment strategy. You are encouraged to seek investment, tax, or legal advice from an independent professional advisor. Any investments and/or investment strategies mentioned involve risk, including the possible loss of principal. Advisory services offered through Brookzone Capital Management, a registered investment advisor.
Fiduciary duty extends solely to investment advisory advice and does not extend to other activities such as insurance or broker-dealer services. Advisory clients are charged a quarterly fee for assets under management, while insurance products pay a commission, which may result in a conflict of interest regarding compensation.